All right, let's talk about another series that's been going on, which is the ongoing issues with the Federal Reserve. So yesterday, the Federal Reserve met, they cut rates. I really found two very interesting statements coming out of the Fed yesterday, which is one in particular was that they don't foresee raising rates anytime until they see a significant rise in inflation. And the second is simply that they're cutting rates at a time where GDP came in yesterday actually stronger than expectations, with consumer spending really kind of holding in here pretty strong. So, it's interesting. The Fed is cutting rates. The original expectation was because of trade wars, right? They were worried about trade. Well, that's getting resolved now. And GDP and personal consumption expenditures seem to be doing okay. They're not great. I mean, we're 1.9% on economic growth, but it's not terrible. And you're cutting rates.
We've talked about this a lot. The natural growth rate for our economy is somewhere between 1.5% and 2%. So after we had the tax cut stimulus, the stimulus from the hurricanes, from the earthquakes, and various and larger budget deficits that were larger in the year before, which all stimulated growth, we're simply just going back to the normal, which is 1.9 may even be above the normal. So you have to question, what are they doing? Why are they stimulating? They need to acknowledge that is the natural growth rate. And that's based on a lot of factors, on productivity, on demographics, on debt. That is, over the long run, will be the natural growth rate of our economy.
Well, so it's interesting. You said that they need to acknowledge that. But in effect, they actually really have, because once a quarter they come out and they release their estimates. When they say, okay, this is what we expect over the next year, the next 2 years, and our long run estimates for GDP growth in particular are 1.9%. So they've already they already acknowledged that the long term growth rate of the economy is about 1.9%, and we're cutting rates when we're banging their long term economic growth factor. So I find it interesting that, and again, this kind of goes back to, I guess, the unknown, right? Which is, what are they seeing, or what do they think they see? Just to remind everyone, the reason the Fed cuts rates is to stimulate economic growth. I lower rates so that people go borrow money and put money to work within the economy, and yet the economy is doing okay. There doesn't seem to be a need at this moment to any great degree of using that ammunition to try to spark economic growth. And at the same time we also have this big funding issue that's going on with banks, and the Federal Reserve is now coming in and buying $60 billion a month in short-term T-bills, but are claiming that don't worry about it. We're doing this, but don't worry about it. There's nothing really, going on here. It's just something we're doing, right? It's just there seems to be something else happening that we're not aware of.
Right. Well, here's the other thing that Powell talked about that is not getting much press, and he said it twice in two different ways. He said the banks did have money, but they didn't want to lend it. Again, we've used this example, Lance. I pull up in a brand new BMW into your driveway and I say, can I borrow $10,000? Here's the key to my car. And if I don't pay you back tomorrow, take the car. It's a no-brainer. You lend me the 10 grand if you have it.
Right.
And apparently the banks had it. So why would they not lend me the 10 grand with perfectly good collateral? And I think the answer is starting, we've talked about this and we've guessed about what it may be. And we keep coming up to that there are decent odds that there is a credit issue going on with possibly Deutsche Bank, some other bank, but there is something behind the scenes going on, which helps explain why the Fed is doing QE, why they're doing so much repo when the banks apparently have money. Shouldn't the banks be lending that money?
Right.
And why they just cut rates for a third time despite growth that is at or slightly above normal.
And while we're having this conversation, I think it's important to remember that, as we said a second ago, the Fed cuts rates to stimulate economic growth. We're doing this at a time where the economy is still growing. And so the real concern here becomes, what are you going to do if we do have a recession? And, on the outside chance that in the next 500 years, we actually have a recession, what are you going to do then? Because you're using a lot of your whatever ammunition you had, you've depleted a large chunk of it. You're doing QE. You're buying bills, and yes, you could accelerate that, but you're already using that ammunition now. So you've reduced the effectiveness of whatever you do in the future, and you're cutting rates to 1.5%, which doesn't leave you a whole lot of wiggle room here.
Lance, in the spirit of Halloween, I have a scarier proposal for
Okay,
you.
there you go.
What if we have a recession with inflation?
Right.
Right? No one thinks inflation is coming, but the Fed just told us they're not going to fight it. At least not fight it until it's much higher. So when there is inflation, the Fed cannot lower rates. They cannot print money. In fact, they have to do the opposite. They have to raise rates. They have to pull money out of the system. So the one wild card, and we don't think it's a huge easy odds bet, but the one wild card that could really trip up the Fed, the markets, the economy is inflation. And yesterday, Powell told us that they are not going to fight inflation until it's significant and persistent.
Again, the inflation that the Fed is looking at and the inflation that everybody deals with are two very, very different things. And from the Fed's point, they have to be asking the question of exactly what type of inflation are they fighting. If you want to sustain strong economic growth, wages aren't keeping up with the cost of living. That's been evident here for a while, and we continue to see that showing up. And I saw a great headline this morning. It says, the headline was, "Credit cards belie the strength of the consumer." What the article was suggesting was that because consumers are spending so much on credit cards, they obviously still have lots of spending power and are willing to spend money. And that's true until you dig down into the credit card data to find out what they're spending their money, they're spending credit on. They're not spending credit on buying televisions and things like this. They're using credit cards to buy food, gas, pay bills, basically essentials, just trying to make ends meet. So it really kind of underscores the potential problem with the consumer. Michael Lebowitz, CFA, joining us this morning. Talk a little bit about the Fed. The decision yesterday, of course, the Fed decided to cut rates for a third time this year to a target range of 1.5% to 1.75%. And, of course, talked about, importantly, that they're not going to raise rates again until they see significant levels of inflation. And Mike, that was kind of the point I wanted to pick up with here in this segment is, when we take a look at inflationary pressures on the economy itself in terms of what people deal with, right? Tuition cost, healthcare cost, insurance cost, food cost, the cost of rent or housing prices, clearly much higher levels of inflation than what is denoted in terms of the way we measure inflation in terms of CPI or personal consumption expenditure inflation. There's a very large difference in those numbers of what people deal with versus what the Fed sees. And they're talking about not seeing levels of inflation. They're not going to act to combat inflation until they see much higher levels of inflation. Well, the problem is that if the level of inflation that consumers are currently dealing with is already substantially higher than what the Fed is targeting, how bad is it going to be before the Fed finally figures out there's enough inflation they need to raise rates?
Well, there's a second part to that, and the government does whatever it can to keep the inflation numbers lower. Mm-hmm. So it's doing all kinds of tricks. It's substituting goods for other goods. It's saying that when we have a technology boost, the price is actually going down, even though the price stays the same or maybe goes up. Mm-hmm. So it's not just that there's inflation. It's that it's being, first of all, I would argue, I was going to say mismeasured, but you can't even measure inflation for a nation of our size. It's such diverse needs, such diverse prices across the country that the idea of measuring inflation is a huge fallacy. Then when you get a Fed that wants to pinpoint it when they say 1.6% inflation is too low, but 2% inflation would be just right. 0.4% is beyond ridiculous. Right. I mean, the variance just between my inflation and your inflation, between you're in Houston, I'm in DC, so we have that aspect, but we spend money on completely different things.
Right.
And we're the same age. Imagine if we were one of us was 20 or one of us was 80. I mean, it's the variances are incredible. So to think that you can measure this thing down to the penny
Mhm.
and then run policy which has a huge impact on the economy is again Halloween. It's scary.
But that really kind of belabors the point of what we were talking about a second ago, which is, we're running, policy, this idea that we have this control over inflation, right? The fact that we can even try to control inflation through monetary policy is almost laughable at some point. It's just kind of been fortunate right now that interest rates are as low as they are, and they've been able to remain low. But those have been more of an impact of demographics and deflationary pressures in the economy, and as you said earlier, productivity, and of course the debt that is being carried not just on a personal basis, but personal debt, corporate debt, government debt. We're running $1 trillion deficit. All that applies to downward pressure on economic growth rates and in turn inflationary pressures. So, the fact that the Fed thinks they can even control inflation is somewhat laughable to begin with.
Right. And when they make a statement like we need to see significant and persistent inflation, I think what that means in Fed terms is 2.5 to 3% inflation for, I don't know if it's months or many months or a year.
Mm-hmm.
But, the problem with that is that bonds are not going to be happy with that. That yields, interest rates
Right.
are not going to be happy, and they're going to go up. Why would you buy a bond at 1.5% when inflation is 2.5%? That means you're losing 1% a year.
Right.
We talk about negative interest rates in Europe all the time, but that is a negative interest rate. It's called a negative real interest rate, after inflation adjusted rate. And because it would be negative, investors, we would hope, would demand higher yields. And we keep talking about this. There's so much debt outstanding that when you get higher yields, it becomes very burdensome on consumers, on corporations, and the government because their cost of debt rises.
Well, and we just saw that in beginning of 2018. We saw interest rates in 10-year Treasury got to 3.25%. Housing stopped, auto sales stopped, everything came to, it was like somebody slammed on the brakes in the economy, and interest rates fell again. So, since interest rates and inflation pretty much track each other throughout history, if interest rates, and to your point, if if inflation's at 3%, interest rates should also be around 3%, because why am I going to loan money to somebody at a rate less than inflation? That makes complete sense. Those attract each other. But if a rise in interest rates negatively impacts economic growth, which is more than anecdotal evidence that is indeed the case, then you can never have higher inflation and you can never have higher interest rates, which means that the Federal Reserve is now caught in a de facto liquidity trap, just as Japan has been in for the last 30 years, which is, I can't raise rates because I can't get inflation, and I can't get inflation because I can't raise rates, because as soon as I raise rates, it impacts all the burdensome debt that we have throughout the system. Japan's at 280% of debt to GDP. We're over 100% of debt to GDP and rising every year. So we're now in that same problem, is that interest rates are now going to remain low. Inflation's going to remain low, and the real risk now to the economy over the course of the next decade is 2% or less of economic growth, which barely keeps up with the rate of population growth. And if you have a recession, things are going to get pretty bad pretty quick.
Right. And maybe we should backtrack a little and explain why the Fed wants inflation. Because, a lot of people are probably wondering, why do they want inflation? Inflation isn't good. I don't want to pay more for something today than I did yesterday. And let's just think about it from there's an easy way. Think about it from someone that buys a house in the year 2000, and they paid $200,000 for that house in the year 2000. They took out a mortgage for $200,000, and they're paying that mortgage. Well, today that house is worth $500,000. But their mortgage is only $200,000. Their wages have gone up, have more than doubled since then. So $200,000 is much less of a burden, and that's what it does. It reduces the burden of debt, and it allows more debt to be taken on because the burden is less. Yeah, and that is the Fed's ammo. I mean, the Fed's come out pretty clear about that they are concerned about debt levels. But what they talked about it yesterday, Powell. It was either, I think it was Powell's that said that they're concerned about corporate leverage, meaning that corporates have too much debt as compared to their earnings. So what's his answer? To keep rates even lower. So, that at first that may sound smart, but what does it do? It gets corporations to borrow even more.
Right.
And the sad part is, what are they doing with those borrowing funds? They're buying back stock and paying dividends. If they were investing in the future, investing in things that would produce income in the future, there's some viability to that. That's great. You're going to borrow today, but you're going to make much more income in the future.
Right.
So maybe that's a good bet, but that's not what's happening. And there's a million different ways to show that they are just basically investing in the stock market with that money.
Right. Well, look, I mean, if you take a look at, there was a chart out this morning in the Wall Street Journal talking about capital expenditure plans for corporations. Capital expenditures are specifically what you're talking about. I'm gonna use money I have to go build something, right? I'm gonna build a new office. Or I'm gonna build a new production facility. I'm gonna make a capital investment into something to create more productivity. Those capital expenditure plans on both small businesses, mid-sized businesses, as well as large businesses, your AT&Ts, your Amazons, those type of things, are falling markedly because they're going, there's not an economic benefit. If I go borrow money at 4 or 5% to go do this, the return on that investment does not justify borrowing the money for doing that. However, if I borrow the money and buy back my shares, it benefits corporate insiders who sell those shares. And again, almost 80% of all the stock buybacks have been done by corporate insiders. So, we take a look at we have a lot of talk about, wealth inequality and about corporate shenanigans, corporate cronyism. And this is, in effect, what we have fostered over the last decade with ultra low interest rates, zero interest rates by the Fed, loose or lax lending standards, and tons of quantitative easing, which put a tremendous amount of liquidity in the market that had to go somewhere. And, of course, the easiest place for it to go was to do stock buybacks and compensate executives and insiders of corporations.
And we've both written about this, but how are executives being paid? They do get a paycheck like you and me, but more importantly, and a much bigger proportion of their income are shares.
Right.
They get options, they get shares, they get stock. And basically their compensation is the stock price. So they're incented to boost that stock price today at any cost. And a lot of times that cost is the stock price in 5 or 10 years, or said differently, the earnings of the corporation in 5 or 10 years. They're basically pulling everything forward because they want to get paid today.
Right.
And in reality, their incentives should be based on where things are 10 years from now.
Well, and look, this is all part and parcel of what happened under the Clinton administration. What was it that Bill Clinton did when he was in office as president of the United States that sparked this whole wealth gap effect that we see in the marketplace today? There's a lot of conversation right now in the country. Democratic presidents are running on these kind of socialistic platforms. We got to go take all the money from the rich people, and we got to end capitalism because capitalism's broken. So we got to be socialist now. And the problem is that there's certainly some argument to be made for the corporate cronyism that has occurred, and that there is a clear excess in executive compensation at a variety of levels. And look, this doesn't exist, by the way, for everybody. This excess compensation does not exist in small cap companies. It does not exist in your neighborhood businesses, the companies that you go get your car service with. You don't have these type of executive compensation gaps that you have. This is mostly existing in mega cap S&P 500 type publicly traded corporations that have stock that can be issued out into the streets and these options issued. Now, this all started under Bill Clinton. Bill Clinton was trying to do something about what was considered then to be excess executive compensation, which, by the way, was not excessive at all back then, but it seemed to be, comparatively speaking to now. But he said, we're going to cap CEO pay at $1 million a year. And well, look, people that run businesses are very smart. That's why they run mega companies. because they're extremely smart. So they said, okay, great, you're going to cap my salary. I'll just pay myself differently, right? There's always an end run around, and this is a problem with legislation. You've got to be careful with legislation because it's always the unintended consequences of legislation that comes back to kind of bite you in the butt. And that's what happened with Clinton. Clinton said, hey, I'm going to do something about this excess executive compensation. We're going to cap executive compensation $1 million. Great. But he didn't put in any other parameters. He didn't say all executive compensation. He didn't clarify exactly what constituted compensation. So CEO said, great, I'll just pay myself in stock options. And that has now become the de facto way that insiders and executives of corporations, and this only exists inside of publicly traded corporations because you've got to have the ability to issue options or warrants or grants or a variety of other instruments. It only happens inside these companies where they can benefit from what happens on Wall Street. And this has led to this massive deviation in wealth between the top 1% and the bottom 99% of the economy.
But here's why it really matters, and it's not the wealth of 200 or 300, 400 executives. Mm-hmm. It's because money is being pushed into the stock market to drive the stock prices higher and not into innovation and productivity, which would help the entire population.
Right.
And that's the bigger problem, is that they're the rule change 20 odd years ago is incentivizing very bad corporate behavior. And it's really been much more so over the last 10 years, so no one associates Bill Clinton with it. But it was that change in the laws that really unleashed consequences 10, 15, 20 years later.
Yep. Well, again, and part of this too has also happened, and part of the blame, and again, there's nobody to blame here. Is all, the changes that were made were believed to be good policies at the time. Again, it's always the unintended consequences that come and get us, and part of this problem actually occurred during Reagan. When Ronald Reagan was in office in the early 80s, they basically they changed the rules to allow stock buybacks to be legal again. And believe it or not, stock buybacks, and most people don't know this, is that stock buybacks were illegal. They were an illegal activity by corporations. For corporations to buy back their own stock was an illegal operation under SEC laws for like 50 years because it is a form of stock price manipulation. And under the Reagan administration, we changed that ruling to allow buybacks to once again be legal. And again, the unintended consequence at the time, there weren't a lot of insiders. There wasn't a lot of stock to buy back. More corporations at that time were kind of, splitting stock rather than doing, share repurchases. So it didn't really seem to be a problem in the 80s and 90s. It's just become the poster child of poor capital constraints in the latest innovations.
Lance, it is not a form of manipulation. It is straight out manipulation. Yeah. These companies are going in and they provide a bid to their stocks at certain price levels that are very important. They are driving the market. Mm-hmm. So, I think you got to be careful. If the corporation really wants to give their money back to their shareholders, why not do it in dividends or special dividends?
Right.
Pay a special dividend, a couple bucks a share. You don't have to buy back the stock. They should have no ability to directly affect the price of their stock. That is insider trading. They have information that no one else has. They are just using the house's money to buy back the stock, and it is just it's really becoming a huge problem. And it's not just for the share prices. Again, it is for the whole economy. It is detracting heavily from future growth rates.
Yeah. And look, there's a lot of people that are and this is one of the kind of the myths that is portrayed by the media. And you just kind of touched on this very briefly, is this is, but this creates shareholder wealth for everybody, right? When companies do stock buybacks, it increases the shareholder wealth of everybody. It returns money to shareholders. It does not return money to shareholders because it's primarily the insiders that are benefiting from stock buybacks. To Mike's point, if you want to return money to shareholders, that only occurs with a dividend. If you want to participate in a stock buyback, then you sell all your shares to the company. You no longer have shares in the company. Yes, you get your money back. Maybe you get it back at a higher price. There's no guarantee of that. There's Apple did $5 billion in stock buybacks in 2018 and lost money on them. But so there's no guarantee that stock buybacks actually make you money, but the only way you participate in a stock buyback is to sell your shares. That does not return money to all shareholders. That returns money to specific shareholders. To Mike's point, if a company wanted to return money to all shareholders, it's done in a dividend, a special dividend, something like that. And that's
Right.
the point. And this is a big misstatement made by the media, is that stock buybacks return money to shareholders, because it absolutely does not.
Right. And when we talk about capitalism, that's not capitalism. The manipulating the share of your own stock to make the executives very wealthy is a flaw in capitalism.
Mm-hmm.
It is one reason that capitalism may not be working as well as it should. And there are, capitalism does need some restraints, but capitalism also needs to be allowed to work.
Right.
And when you have rules like this and many others, it is why capitalism is being blamed for the problems we have.
Well, and exactly right. And it's not just, stock buybacks that's distorting capitalism.
There's a lot.
Yeah, it's low interest rates. It's indulgence into corporate debt. I mean, capitalism should be, and the biggest problem we've had with capitalism in the last decade is the fact that we haven't allowed capitalism to work. And what I mean by that is that in true capitalism, companies live or die by their actions. And when you start bailing out companies or doing things to support companies that should be out of business because they're a bad business model, or they are functionally broke as a company, and they're being supported by government interventions, that doesn't allow capitalism to work. The reason capitalism works is because it allows companies to fail that should fail, and allows companies to succeed that should succeed. And we haven't been allowing capitalism to truly work, so we've distorted the real value of capitalism.
And even on a lesser scale, it allows the companies' share prices to go up that are making a lot of money, and to go down that are not making a lot of money. And then the executives are incented to do something because their share price is going down.
Right.
And unfortunately, in this market that's driven by the Fed, by low interest rates, by passive investing, every stock goes up. Because the S&P goes up and every stock is in an ETF, so it goes up regardless of what its economic fundamentals are.
Well, and again, so when you talk about this, it's not a surprise that you've got people like Elizabeth Warren, Bernie Sanders, et cetera, running for office, talking about changing the dynamics of capitalism, moving more towards a socialist society, in these ideas of free money, free education. And there are very negative consequences historically of those actions, which are much worse, actually, than broken capitalism. It'd be so much easier just to fix capitalism than to change the entire capital structure of the economy.
Well, Lance, I would say we are moving towards socialism already. Between the Fed and the government spending trillion-dollar deficits, that's socialism.
Yeah.
When the government dictates the economy. And she's just moving more so. I mean, she's trying to get ahead of the trend.
Yeah, absolutely.
And that's the scary part, is that Republican or Democrat, they're both going in the same direction, just different ways.
It's a rich man's world.